Don't take profit until it's time to take profits. You want to take profits in these stocks at a certain point. You don't want to ride them all the way to the top. The only way you can have a disciplined exit is you gotta pick a top and you gotta sell to it.
All right, welcome back to the Next Big Rush. I am Fabian. I am here today with somebody who is super special. I like to call him secretly the guy who has the Midas touch right now in the gold market. He's going to be really humble about it because that's the kind of person that he is. But whenever Don Durrett comes out and says, look at this stock, I think it's going to go somewhere, lo and behold, mere hours or days after the fact, it runs. So for whatever it's worth, Don Durrett is the man of the hour here, but he's been in this business for a very long time. So Don, welcome to the show.
Yeah, Fabi, thanks for having me on. First time.
Yeah, first time, hopefully first time of many. Don, for the people who are watching this and trying to get a grasp for, have I missed the boat when it comes to junior gold miners, silver miners? Have they missed the boat in your opinion? Obviously, you don't have a crystal ball, but with your experience in this market, where do you think we are and how much upside do you think we have from here, whether that be in gold itself or in the juniors?
Um, it's hard to know exactly how high this bull market will run in the gold silver miners or how long it will run. But the one thing, the reason that I got into this is basically unfolded. So I actually became a gold bug 1989, bought a gold mutual fund 1991. Throughout the 90s, I was putting $500 a month in a gold mutual fund for the entire decade of the 90s. That shows you how much of a gold bull I was when the technology stocks were all ripping higher and people were saying, "What are you putting your money into?" I said, "A gold mutual fund." They're laughing at me because gold was like $250. Well, that gold hasn't done squat this decade, Don. What the heck? What are you doing buying that? I go, "You watch, watch what happens." And so my thesis has always been, I think, correct. And the thesis is that the US government is playing a dangerous game here that they can't win. So they're trying to use debt to generate our standard of living. So we're living off of debt. So we're increasing debt faster than GDP. Historically, the economies that work are the mercantilist economies, which we had a mercantilist economy from 1945 to 1970, and it did fabulously well. And then Japan had a mercantilist economy from the late 60s till like 1990. They still have one, but they did fabulously well. And then the Chinese, fabulously well. I mean, if you look at some of the videos of the cities that they built, mercantilism works. Living on debt doesn't work. And so to me, it's just so obvious. It's like it's right in your face. It's like it's just a matter of when. And so 2004, I was jogging with a friend, and I told him you should buy some gold mining stocks. But at the time, I was still doing mutual funds. I was actually on my second one at the time. The first one, I got to 5,000 shares, and I said, "Oh, that's enough. I'll go do it." And I started doing another one, and I'm doing my second gold mutual fund, and he goes, "No, I prefer silver." I'm like, I had never even thought of silver. This was in
Interesting.
2004. I never even thought of it. So I go and I try to find a silver. I respect this guy. He's smart.
It's a good timing.
So I go try to find a silver mutual fund. They didn't exist. There was no SILJ back in 2004. There wasn't any. So I decided I was going to buy some silver mining stocks. Okay, I'm going to buy some silver mining stocks. So I had to learn from scratch. And I'm kind of a type A personality, so I dive in, right? I got to learn how to do this stuff. So I sent it, there was, at the time I was listening to a podcast. I sent them in an email question and asked them, what book should I read on junior miners? The guy goes, it was Bob Chapman, I think Chapman. And he goes, "Sorry, kid, there isn't any. There's nothing out there."
That's
So
how
there's
popular it
nothing I
was.
can recommend. So I had to learn on my own. And in hindsight, that's actually was a good way. It was hard as hell, but I ended up learning really well. And so um, so from 2004, so my thesis was still in place. The US government is going down this dangerous path. And debt started exploded in 2000. I mean, it started in the 90s. They were actually balancing the budget, but I still believe it's over, you know. Um, and then it started kind of work going my way from 2000 to 2011, right? And I did really well in that decade. But I started collecting junior mining stocks 2004. I'm more of a collector than an investor, so I have like 165 stocks. And the reason why is because I found very early on that my personality doesn't work for trading. So if you concentrate your portfolio, if you have like 20 to 30 stocks, you have to actively manage them because you have high concentration. My personality doesn't do that. I like to wake up in the morning and not think about my portfolio. I don't want, so I learned really, really fast. I wanted to take the emotion out of it. And the way that I learned really, really fast is because I was buying a bunch of dogs and they were basically just crashing. So you learn really, really fast what you can handle, right? So I learned kind of my pain point, and I learned all these things. I have like a pain point. If I stay below my pain point, I don't care. So on a high risk stock, I'll just stay below my pain point, and I
What do you
buy it.
mean? What do you mean by staying below your pain point? What
So
does that
you'll
look
learn your
like?
pain point real fast. It's like if a stock goes bankrupt and it bothers you, it's above your pain point.
Gotcha.
So I've had a lot of stocks go bankrupt over 20 years, and some of them I don't care. I mean, so I've learned my pain point. Like Victoria Gold, I had my level on Victoria Gold because I don't go much above. I learned this. So I invest 0.25, zero point 0.5, and 1%, depending on the quality of the company. So if it's a really, really quality company that I really like, I'll do 1%. And then I go down from there depending on the risk reward. So I was like in the middle of Victoria, 0.5. Amazingly, zero point 0.5 is my pain point. It just kind of happened to happen. That's what happened. Because I found that if I invest at 0.5 or less and they go bankrupt, I don't care. So that was my pain point. So I learned that really, really well. So that's helped me immensely. It's basically de-risked my portfolio. And then in my book, I talk about using a pyramid approach. And the pyramid approach is the bottom of your pyramid is your base, and that's where all your low risk investments are. So you have more allocation on the base. So physical is the very bottom of the base. That's the least risky. Then above that is your ETFs and your mutual funds. And then above that is your majors. So you want a really, really strong base so you can handle volatility. And that's what I've done. And then above the majors is your mid tiers. So I want to own a whole bunch of quality about 2/3 up the pyramid. And I love producers because I think producers are going to give you the most bang for the buck, the best risk
Mhm.
reward. And then your developers and your exploration are way at the top of the pyramid. So that's how I've de-risked it, taking the emotion out of it. But what's happened, I've ended up owning a whole boatload of stocks because it's taken 20 years for this thing to get to the top. If it
Mhm.
would have taken 10, I'd only have 100 stocks.
Mhm.
But I got to 100 stocks and I said, okay, Don, you should stop. No, sorry, because I keep finding stocks I like. If I find a stock I like, I buy it. It's that simple. So I went 125. Don, you should stop at 125, 135, 150. Okay, this is it, 165. That's the very top. So I really think that I'm pretty much at the top here.
Got
I
it.
don't think I'll get to 170 individual stocks. I have about 165 individual stocks and about six ETFs and three mutual funds. And I think that's pretty much it, plus physical, plus some crypto. And that's my portfolio.
Okay, so do you ever rebalance? I mean, what triggers a sale for you?
Yeah, so I don't take profit. I learned this lesson so I made a bunch of money on First Majestic. So I bought First Majestic in 2009 after the crash at about $1.15, and it went to $25. So I had basically a 25 bagger, not quite a 25 bagger, but close. And I learned a lot from that investment. And then it started going down. I got to $20 and I said, okay, why don't I just take my profit out? So I sold 500 shares. So it was running all profit. I learned a lesson from that. I was angry at myself. I wanted those shares back. I didn't care this is the interesting thing is that I knew that I still believed in my thesis that gold's going to the moon, silver's going to the moon. So even though First Majestic was correcting back, I wanted those 500 shares back. I'm like, I want those 500 back. I didn't buy it, I'm not going to buy them, but I sold them. And so I learned that lesson. So I don't take profit. I have a until you take profit at the right time. And it's interesting. It was one of the best investors. He said that his biggest mistake, I mean, this guy is one of the all-time greatest investors ever. And he said his biggest mistake was selling early. And I totally get that because when I sold those 500 shares, I was selling early. And so I don't do that. So I have a stock right now. I have a 28 bagger in it. And I haven't taken, you can't, you're not taking, you can't have any of my shares. I'm sorry. I'm not going to sell a few shares just because I'm running, it's all profit. No, no, no. That's not how I think. I think in terms of you sell at the right time. You buy at the right time, you sell at the right time. You talked about rebalancing. So I just told I don't take profits, but I do rebalance. And the way you rebalance is when you buy a company, you buy it because it has a story you like. So if that story changes for the negative, you got to start thinking about, okay, this isn't really what I bought. Do I really want to hold it? And those are the stocks that you sell. I basically you swap them out. And so I swap stocks that the story changes, and you should do that too. I don't take profit
Mm-hmm.
until it's time to take profits.
Mm-hmm.
You sell it to you sell to make money. You buy. I mean, you buy to make money. You sell to make. So you buy low and you sell high, and you make sure you don't sell too early. That's a mistake. And so it's a mistake to buy high, and it's a mistake to sell early, sell low. And you need to recognize you're selling low. And when I sold First Majestic at $20, I was selling low. I learned that lesson. But I do swap, and I'm constantly swapping. So like right now, I have 165 stocks. That will be down to probably 145 when silver's at 4,500, maybe a little higher than that. So 45, 46,
Sorry,
47,
do you mean
48.
gold is at 4,500?
Gold, yes, gold.
Okay, okay.
So when gold gets somewhere between 45 and 48, I will probably start doing some swapping because as gold goes up, we know which stocks are working. So what stories you bought are working, and they're probably going to continue working. So you want to rotate money out of the stocks that aren't working into the stocks that are working. So I'll probably rotate about 20 stocks. So I'll sell those 20 and put that money into the ones that are working. So I'm not taking profits yet. Still too early. Now from 45 to 4,800, I might take profit in a few that are doing extremely well, but they've done extremely well. They've done extremely well. They're like five baggers plus. But simultaneous to that, their story. I'm starting to question the story. Like they might have acquired a project, in a location I don't really like, something like that. The story is starting to change. So the thing about investing, and this is where I'm very useful to investors, is understanding these companies. And so the way you understand it is you read my book. So remember I said there was no book in 2004. Well, guess what? There's a book today and I wrote it. And all you have to do is read chapters 6 through 10, and it's basically everything I've learned, and I've learned a lot. So it's basically a textbook, but it's very detailed. It tells you how to understand a major, a mid-tier, and an exploration company. Those are the three categories. My book literally explains how to understand these things. So you understand what you bought. And so that's important. So once you understand, because the thing that makes gold and silver mining so difficult. This is why Wall Street doesn't understand it, because they won't put the time in to understand these things. They're unique animals. Mining stocks are so unique. They do not have competition. They don't compete against each other. They don't even have customers. That's how crazy this business is.
That is true. And nobody cares that they don't have customers.
They have buyers.
Mm-hmm.
And Newmont and Barrick do not compete against each other unless they're trying to maybe buy another company they both like. They might bid against it. But by and large, they don't compete against each other. They compete against themselves to see themselves basically make their share go up based on how much gold they can find and how much it costs to get out of the ground. They're competing really against themselves, how much profit they can generate. That's it. And then they don't have customers, they have buyers. So they don't have to sell to the same person. there's going to be plenty of buyers that are gold. So it's a weird business. It's really weird. It's cash focused. Plus, this makes it even weirder. Two other things that make it a really strange business. Number one is their product disappears, and then it's really hard to go find it again. So you have a gold mine, it has a 10-year mine life. Well, once that 10 years gone, now you got to replace it. Well, guess what? It's really, really hard to replace it. So
And very expensive.
it's a weird business. So you have to approach it from a different angle, a completely different angle. It's so bizarre. I mean, and so I have these methodologies that I use, and I'm helping people do it, and that's what the book's all about. So I have like these 10 different factors for a producer, 6 for a developer, and then 2 rules for exploration that I've learned. And so you use this disciplined approach for finding good stories, and then you use a disciplined approach for buying them. And we're going to answer that question next. And then you use a disciplined approach for exiting. Now let's talk about when you buy and are these stocks currently expensive? So what I do, and I've been doing this since I've created my website, and I'm the only guy that's done it, but now people are starting to catch on to my thesis, the way that I do it, is I use future gold prices, future silver prices, future production estimates, future cost. I really don't care about the next 12 months. It's irrelevant to me because it's a weird business. You got to think down the road. You have to think about, okay, how much is this company going to be worth in 2 to 3, 4, 5 years at higher gold silver prices? That's how I've always thought. And nobody else does this. I'm going, this is simple
in fact,
stuff.
we're looking at today's gold price and we're completely discounting it, right? We're going through all
I don't even,
PAs,
I'm like way past this
feasibilities.
price.
We're like, 2,800. That's a little,
Yeah,
it's a little on the high end.
Everybody thinks the next quarter, the next 12 months. It's like, that's irrelevant, man. Ignore that. And interestingly, Eric Sprott, he's a billionaire and he's one of the best investors in this space. I'm the only newsletter writer he's ever mentioned because I'm the only one that thinks down the road. And I love a quote from Sprott. He said, know the future early. And that's exactly what I do. Know the future early. The future is, what's going to happen in 3 years, and bet on that. And that's the reason why I've been successful on telling people what these stocks are going to do. I used to say, because I knew it gets pretty easy if the gold price, if your forecast are anywhere close. So I've been using $5,000 gold and $100 silver for a while now, and now we're up to 4,100 today. So I'm gonna have to bump that to 5,500. And when silver gets above 55, I'll have to bump my silver price to 125. And so we're still early here. I was looking on Saturdays, I do a live podcast, and I was looking at the Mormons, which are the 8 prettiest girls. So you can marry all 8 of them. That's why they're called the Mormons, the 8 prettiest silver miners. And none of them there's about 3 of them that are close to being pricey. Close. In other words, if they go up another 50%. But right now, all 8 of them are still, in my opinion, you can still buy all 8 of them. So we're getting closer and closer. And the other thing that hasn't happened yet, it tells me we're early, is the stock market is still near its all-time high. Wall Street, there's $63 trillion in the stock market. Maybe it went down, maybe it's a little 62 because it went down a little bit. Mm-hmm. But that money, only a little tiny piece of it is in the mining stock. And so once that money, when it rotates out, when people are going, I don't want to own those stocks anymore, and somebody goes, yeah, but you might want to own some of these miners, right? They jump, and so that money's going to rotate into the miners, and I call that the fear trade, and it hasn't started yet. So we got a ways to go. My target for the HUI, which is currently a little over 600, is 1,500 to 2,000, and I think 1,500 is really conservative. I'm expecting 2,000, and so we have a ways to go here. I don't think we're people are late to the game yet.
For
Getting
my,
close though.
for my own benefit, I hope you're right, Don. I really do. Okay, so we're talking about buying stocks, right? And that historically and where you see this bull market going, you don't think that we're super close to the top yet because everybody's looking backwards instead of forwards, and there's a lot of money to come into this industry yet. What else makes a company cheap today?
It's all about free cash flow. So for me, the number one place that has the best reward is your producers. So what you do is you look at their current free cash flow based on the current market cap. And basically, they're going to have a multiple. Their current free cash flow is going to, let's say that you have 10 million in free cash flow and $100 million market cap. That's a 10 multiple. So you want to buy these stocks that kind of below 10, because they could easily, the multiple could double. So you're basically buying half off, maybe less than half off of where they're going if the multiples expand. And the multiples will expand if gold prices go up. So so one thing I look at is the current multiple. Looking for really good stocks that are like 5 or 5, 6, 7, somewhere in there, even lower, but 3 to 7, somewhere in there, I look for that. But the thing that I look for even more than the multiple, that's kind of a one starting point. The one thing that I look for even more is what I call the future market cap based on free cash flow. So I estimate their future market cap, and then I compare that to the current market cap. When you compare the two, you're going to get an upside. So the way that I calculate the future market cap is I take estimated future production. Let's go small. Let's just use 10,000 ounces. And then we use the times, let me put it in brackets, the future cost, no, the future gold price, future gold price. So we're going to use $5,000. And then we're going to subtract their future cost. And we'll use 3,000 to make it somewhat round. So you subtract those out, you get $2,000. Then you multiply that by the production, which is 2,000, and you get, trying to make it very easy. It's going to be $200 million free cash flow. 2,000 times 3 is 2 million. No, it's only 20 million. So they'd have 20 million in free cash flow. Mm-hmm. Then you take that 20 million and you apply a future multiple. And so in this case, I'll use 10 just for a round number. And that will give a future market cap of $200 million. Now, if their current market cap is 20 million, then it would basically have 10x upside potential. Got it. And so I look for stocks that have at least 4x. I really don't like to go below 4x. And the only time I'm really going to go with a 4x is if I think it's going to grow. I think it's kind of a growth story. But most of them, I'm looking for 7, 8, 9, 10 levels. And then anything above 10, I'm really get excited about. And every once in a while, I'll find 25s. Like when I was at Beaver Creek, I found 2 25s that I was just excited about. So the first one was 1911. And that stock's up over 100% after Beaver Creek because it had this 25x upside potential based on my if gold goes to $5,000. And now more people are thinking, oh, gold probably will go to 5,000. So if you project that one out, it looked 25, and now it's kind of down 10 to 15 bagger from where it was at. And then the other one was Talisker Resources, and that's another one that's probably up 100%. Both of those stocks, when I was at Beaver Creek, they just screamed undervalued, just screamed. I mean, because based on the way that I do things, based on my future market cap. And those future market caps on those two companies was just way above their current market cap. I did the same methodology on Newmont when Newmont was at $30. And I told everybody, now one of the things I like to do is buy to the bottom. So you buy to the bottom when you identify a bottom. You basically go, that's as low as that stock. That stock can't go any lower. At that point, you buy it. If it goes lower, you buy more. It goes lower, you buy more. It's called buying to the bottom. So Newmont was at $30. I said, buy this stock to the bottom. It's not going much lower than 30. It never got below 29.50. I mean, I know that to like a
Nailed it.
quarter. I just said, there's no way Newmont's going any lower than this price. Buy this to the bottom. And then I also said that my target was $300. It was a 10 bagger. Newmont, and this was in February of 24, February. I basically, Newmont, well, it's basically a 9 bagger from $30. Newmont is uber cheap here at $30, people. Buy this stock, and now I think it's at least $90. I haven't checked it, but it's basically up 200% since I said that, and heading to 300 if gold goes to 5,000. And so, but if Newmont is going to go from 30 to 300, Newmont is the largest gold producer in the world. They're going to go from 30 to 300. Guess what the rest of the mining sector is going to do?
Exactly. And then that's even more exciting because, that's the kind of companies I like to buy, the smaller stuff that isn't, sitting inside hedge funds portfolios, at least not just yet. So, okay. Do you give any weight, Don, to the quality of the management team? And if so, like, how do you assess that?
Yeah. So, I mean, one of the things that's cool about my website is you can go and get my opinion of their management team. So I have on there something called a scorecard, and I want to, I want, so it's 1 through 5 stars, and I want fours and fives. I mean, ideally, I want to do fours and fives. So if you see me with a 4 and 5, I'm basically saying I like this management team. I think it's a good management team, right? And if it's a 3, then it's marginal. It's like maybe it's good, maybe it's not. We're betting on it, right? It could be, it could turn into a good management team. So you can think of it as kind of an 5 stars an A, 4 stars a B, and then 3 stars a C, and 2 stars a D, right? And so, but there are different. There's, the one thing that I've learned really about in these mine stocks is these levels are, you can stretch them out, right? So you can have the high end of the range and the low end of the range. So if you have a stock management team that I have 3 stars on, you don't know if it's at the upper end or the lower end, right? It's really
You don't know if
difficult.
it's a 3.9 or a 3.
Yes, you don't know, and that's the hard part in mining. Well, Don's got it as a 3, maybe maybe it has it, maybe it's a good mine. In actuality, is barely a 3, right? And so that's where experience comes into play. So I have a lot of stocks but here's the takeaway: if it's a 4 or 5, it's a 4 or 5. Those I don't give those away. There's not that many 4s and 5s on mine. And then now, one of the things I've done is the ones that have a 3, you really don't want the ones that are 2, right? So the ones that have a 3, I've given them a secondary rating. And so what I did was I created a grading scale, A through F. And that is the quality of the company, which includes the management team. So anybody that has a 3, you go and you check and see what my grade is. If I have a C, if I have a 3 with a C plus, it's lower end.
Got it.
If I have a C with a B, okay, it's kind of the upper end. So you can use that quality in tandem with my management, which is very useful. The one thing I like to do that I think is really important is watch an interview by the CEO. That is a really good tell. And then the other thing you want to look at it is that what their actual execution, how they actually, check their news releases, for the last 2 years, and see exactly how they're presenting the company, what kind of news releases they're giving out. And some of these companies, you can send them an email and ask if you can talk to the CEO. And sometimes they'll let you talk to the IR person if they have one, or maybe somebody else on the team or the CEO, maybe. But believe it or not, about a third of them, this is kind of crazy, about a third of them will not reply to your email, it's like they have on their website, they'll have contact information like info at. You send them an email, they don't reply. It's like, why do they even have that contact information on their website? It's unbelievable, but about a third of them won't even reply.
So if I'm looking at a company and I see that you've given, the management team a 4 or 5, what kind of behavior would make it drop down to a 3 for you personally?
Bad execution. It hasn't happened.
Promising and not delivering,
Yeah,
not
yeah.
hitting the numbers.
I can't recall it. I can't recall. Usually, once you get to the 4 level, you've earned it, and you're not going to fall back.
Mm-hmm.
Mining's difficult. So
Yes.
sometimes when a company makes a mistake, that doesn't mean that they're going to continue making mistakes.
Right, right.
So benefit of the doubt. For instance, Jarrett Canyon. I mean,
That was unfortunate.
uh, First Majestic, they made a mistake with Jarrett Canyon, and people were like, hate that company, just for that one mistake. I didn't. I'm like,
It was
they
also a
got,
bear market, Don. Okay, so like
well,
people
you have to
were
look at
stressed.
you have to look at what they did from,
True.
2000, and I don't know, when I came on the scene in 2004, they were already a producer. So from 2000, let's say 2002, 2003 until they did Jarrett Canyon. I mean, they did a great job in Mexico. I mean, building and operating mines. So they make this one mistake, and you think that's the end all. I I I always said that they'll fix Jarrett Canyon, but they were waiting for the price to go up. Um, Jarrett Canyon wasn't their team. It was a third party that was operating that mine. So now they're going to bring in their team. I expect them to fix it. I really do. So they're definitely a 4. Just because they messed up on Jarrett Canyon doesn't take them down to a 3.
Got it. Got it. But people coming to this industry right now, they won't really know the backstory and won't really be able to quickly assess, the whole context. That's why, something like your resource will be so useful for folks just starting out. What are some of the common pitfalls that, newbie investors fall
Yeah,
for?
the first thing that newbies make a mistake on is they think that exploration companies have kind of the same risk reward as a development company, and it's like night and day difference. Um, I mean, that was one of the first lessons that I learned, was that exploration stocks are really, really risky. If they don't find more gold, exploration companies exist to find gold or silver. That's the purpose of their. And so if they don't find any, you got a problem.
And
And
they're
it's
worth
not easy.
nothing.
And it's not easy to find them. It's not easy to find big mines. And so I created these 2 rules to help people to kind of avoid that risk problem. So for exploration companies, and rule number 1 is it's okay to buy optionality. So optionality is when you buy gold or silver in the ground that's below market price. So if you can buy gold in the ground under $10 or silver under the ground under 50 cents, and it's a big deposit and it's in a good location, that's like printing money. I remember Banyan was at $8, and it was like, this is just free money. It's just sitting there.
Yeah.
I mean, there's no way it's staying at $8.
Yeah.
And 2 months later, it's at 32. So it was like a 3-bagger in 2 months. That's a perfect example of optionality. The second rule is you shouldn't buy an exploration company unless it's early in the Lassonde curve. If you
Tell us more. Somebody lands here, doesn't know what the Lassonde curve is. What does that mean?
Yeah, Pierre Lassonde created this curve for the mining companies, the way they work, and you can look it up, and it usually it holds pretty closely. So in the very early in the Lassonde, you want to buy it early in the Lassonde curve. That's when a company is very cheap. So it's the share price. So on the share price, I put my finger up. So it goes up. It's like a mountain. So you're down here at the bottom, and then the curve goes up like into a mountain, right? And it's going up, up, up. That's when they're finding the mine. So they drill it out, and once they're done, and they basically drilled it all the way out, it hits the top of that mountain, and then they go to development. Well, development costs money, so it starts going down. So you want to buy it before it starts going down, but you don't want to buy it when it's close to the top. So you want to buy it to the bottom. And so you want to buy it to the bottom, and then you hold it, hold it, hold it, hold it, hold it. It gets toast to the bottom, you sell. And so, and there's a secondary piece to this. Yes, you want to buy it early in the Lassonde curve, and it's really easy to identify early in the Lassonde curve. You just look at their chart. I mean, if the stock is uber cheap, it's early in the Lassonde curve. By the way, the Lassonde curve is the share price. That is the share price, right?
Yes.
And so if you're buying it early in the Lassonde curve, it's uber cheap, right? And so Usually you want to buy these companies somewhere between 5 million and 50 million. You don't really want to buy them north of 50,
Mhm.
um, in my experience, but somewhere between 5 and 50 is usually a good entry price. In tandem with, this is the key, right? It has to, for this, they have to have an excellent drill hole. So a
Hmm.
guy did a study, this was at least 5 years ago, probably longer. He did a study and he compared all of the mines that are like over 1 million ounces to the biggest gram meter hole that deposit had. And he found a 90% correlation of the gram meter to the size of the deposit.
No
And
way.
so the takeaway was really, really obvious. You don't buy an exploration company until they have a big gram meter hole. Because if they don't have a big gram meter hole, they don't have a mine yet. They don't have a big mine yet. So what you're looking for is you want the gram meter to be at least 200. So if it's at least 200, that would be 10 meters by 10 grams by 20 meters. If it's at least 200 meters, then there's a good chance it's over 1 million ounces, which is a good start and could be more than 2 million ounces. But and then as it goes higher, the mine size gets higher. So if you can find a gram meter north of 300, that's even better. So 200 is like the minimum. That's like, okay, it had a gram meter hole at 210. Well, that's not, you're not going to get uber excited about it, but you might go in because the next hole could be could be
Hmm.
300.
Hmm.
And that's what you're looking for. Now, ideally, you want like a 500 gram meter hole. You get a 500 and you go, whoa, this is a 3 million ounce deposit. Now,
Those are
this
rare.
really, this really, really, really kind of rings true. Like when Snowline, when they did their initial discovery hole, it was north of 300 and their market cap was like 35. And then they had some follow-up holes up to 1,000 gram meters. And it's
Hmm.
turning out to be 1,000, 10 million ounce deposit.
And the
So
deposit is still growing. Still, yeah,
right, right. So
still
you
got
want to
lots.
make sure that early in the sun curve with an excellent drill hole. If you do that, you lower your risk dramatically. And if you follow those two rules on exploration, um, and the third, I don't have a third rule, but kind of a indirect third rule is you want to take profits in these stocks at a certain point. You don't want to ride them all the way to the top. Um, a lot of times on these exploration stocks, once you get like a two, three, four bagger, it's kind of time to swap it. Go. That's what I do.
Hmm.
Very rarely do I hold these things all the way to, till they actually sell or where they top. Once in a while I will, but the majority of the time I'm basically going to exit. Like Oh My was another one of these ones that was just crazy cheap exploration optionality. And that thing's been like a 20 bagger for people. And so you once those things just rip, you got to pivot. Collective mining was another one. And so, but on the whole, if I would have completely avoided exploration, it wouldn't have hurt my upside. If I just focused on producers and developers, I would have been fine. But by doing explorers, I learn more and I can talk about it, right? Because I'm kind of a teacher. So it's good that I didn't avoid it. But in my book, I talk about all the negatives of exploration companies. And I actually say, if you avoid exploration companies, it's not really going to hurt you. If you focus on producers and developers, you're going to do really well. You might even do better because there's so much risk in exploration companies.
A lot
And
more
it's
risk.
really difficult to find 10 baggers in exploration plays. Very difficult. A few people will find them, but you also find if you actually are going the people see this is the real kind of catch 22 is that yeah, you will find a few 10 baggers in exploration, but guess what? You will find a lot of dogs too.
A lot.
So the
A lot
trade-off
more.
the trade-off is going to bite you. And so the net isn't fantastic. Whereas producers net is absolutely fabulous if gold prices keep going up. Gold prices go to $6,000, $7,000. The producers are going to do unbelievably well. Today, um, silver prices are up. It's Monday the 13th, and silver prices are up $2.
Hmm.
Heckler and Koch are both up 8%. And I've been saying that Heckler and Koch, because they're producers, if silver prices go up, their revenue goes up. And so they're just going to just ride silver up. And eventually Wall Street is going to buy Heckler and Koch like candy because it has liquidity and it has location. And you can't find that in other silver miners.
It's
And
true.
so
That's true.
they have that going for them and nobody else has it. And so those stocks you can do. Now, yeah, and so they outperformed like Fresnillo and Hochschild, they were only up 5%. And so,
Mm.
well, last night they were up 5%. I don't know, they might have been up more today. But those stocks don't have that going for them. They don't have the location. They have the liquidity thing going, but they don't have the location thing going for them.
And that matters. That matters more and more in this market for sure. Okay, so let's pretend this is a year down the road for some reason, or for the reasons that we already know, money printing and all that. Gold is at 5,000 and silver is at, say, call it 100, 120, whatever the number is. But the underlying issue as to why those two metals went up still holds. Are you liquidating your portfolio or are you holding? Or is your main thesis based on what's causing these two metals to rise? I mean, at what point do you say, okay, this is my exit signal?
Yeah, so I write about this in my book and I talk about it on X all the time. So I had a disciplined approach to building my portfolio. I'm going to have a disciplined approach to exiting my portfolio. I'm not going to just sit here and wait, and then sell it all. I'm not going to do that. So what I'm doing is I'm actually picking a top in advance. And so I'm not going to wait for a top. I'm going to pick it. And so if I pick the top in advance, I'm not going to sell the very top. I'm going to sell to the top. So I've picked 5,500 as my top. And so I will sell to that incrementally. But when we get to 5,500, now the one thing is I will change my mind on how aggressively I sell depending on the macro factors that are pushing gold higher. For instance, I keep telling people on X over and over again, do not take profits until at least $4,500 gold. And the reason why is because $4,500 gold, the odds are just in our favor that we're going to get there.
Mm-hmm. Mm-hmm.
They're just totally in our favor. I mean, it's a
Everything
10%.
is screaming towards that, both fundamentally and the charts, and everything is
Yeah,
just like
it's a 10% move from here. I mean, the chances are very, very good. Even if we correct 20%,
mm-hmm.
that doesn't mean we're not going to turn around and go back up to 4,500. So let's wait until we get to 4,500 and then see what the macro, factors are that are helping gold. If my gold might even be stronger at 4,500 than now. And so I'm not going to sell very much at 4,500, if any. I might say, okay, now I'm going 4,800 to 5,800. I could pivot higher. But my thesis is I believe in cycles. And cycles are evident. You got to be blind not to see cycles.
Mm-hmm.
You had a bull market in gold from 1972 to 1980, 1971 to 1980. Then you had another one from 2001, 2002 to 2011, right? And now we have this one. Some people say started in 2016. I think it started in 2019, actually January 2020. So I think this is going to 28, which would be nine years, because you have a zero that year in 2020. So I think this is going to go all the way to 28. And so, but it's going to end. So you can't just wait. Okay, I'm going to wait till 28 and sell everything. I mean, you could do that, but that's not really a disciplined approach. So I want to do a disciplined approach where I slowly get out, but I want to be completely out either at the top that I pick or a little bit past it. I'm not now. A lot of people are going to try to maximize this, and they're basically going to stay in because the macro factors are there, and I'm just they're going to ride, and basically they'll have higher targets. They're like, I know gold's going to 7,000. I know gold's going to 10,000, right? So I will be leaving early. I'll probably be all out when some people haven't even taken any profits yet. But
But you can afford to because you came in so early.
exactly. I came in early, so I can leave early. That's exactly the case. Most people are coming in now, a year ago. I've been doing this for a long time. And so I can leave early and I plan to leave early. And the reason why is because the only way you can have a disciplined exit is you gotta pick a top. And you got to sell to it. You can't pick a top and then sell a top. That's not smart. Okay, I'm going to pick the top 6,000, and then I'll just wait to 6,000 and sell everything at 6,000.
Or if it doesn't hit, you hold on to forever for the next 20 years.
Yeah, very, very well said.
I've
Very
seen
well
that.
said.
I've seen that. Not a good strategy for sure. Don, thank you so much. This has been very insightful. I will definitely circle back and take another look at your website because I haven't been there in such a long time. And then people can find out more at goldstockdata.com. Is that correct?
Absolutely. And then I have a Substack, Don Durrett Substack that I post on, and then I have Twitter, Don Durrett Twitter. So
Awesome.
those are
We'll be
kind of
posting all those links here below. And if you are watching this and you're new to the gold space, you're new to the junior mining space, welcome aboard. There's a lot to learn, and this is just a start. So take your time, make your favorite beverage and go and check out Don's website so that you can take a look at what the different companies are being rated as and the difference between them. And, don't be afraid to get on Twitter and ask questions. There are tons of really helpful investors out there who, will walk you through the differences between different companies. And if you go on YouTube, you're going to see so much content around all these different
one,
companies and the theses that,
right.
you'll be in good
What,
hands.
Fabi, one thing I want to point out is that silver and gold mining investment, it really isn't investing. This is really speculating
It is truly.
because the reason why is because the volatility. The average
Mm-hmm.
person cannot handle the kind of volatility that you'll see. These
Yeah.
stocks can go down 5 to 25% in a single day.
Yeah.
Um,
Or worse if their exploration and the exploration
yeah,
fails.
the volatility. I mean, you can lose. Your entire portfolio can be down in a single week 20%. It's
Mm-hmm.
not uncommon.
Mm-hmm.
My portfolio went down 70% in 2008. 70.
It's a lot.
So I know all about getting completely beat up, but I had it all back to even fairly quickly because
Mm-hmm.
I bought the dip in 2009, and then these stocks they took off in 2009, 2010. So I've learned to kind of ride these bull markets up and down, but don't think in terms of I'm going to buy the stock and all it's going to do is go up.
Yeah,
It's not. 1911, I think it was down 20% last week, and I mean it was always up over 100% and then off 20% in like 2 days.
exactly.
And so a lot of people is like, oh my God. I mean, so you'll learn if you can handle the volatility, but yeah, you're going to be riding a kind of a bucking bronco here. I
And this,
believe that our portfolios will be down at least 20% at some point, maybe in this quarter. The next 2 quarters, at a certain point, it'll be down at least 20% is my expectation. And some of
mhm.
your stocks are going to be down 30%, 35%. So if you're going to go for baggers, I call it, two, three, four, five baggers, if that's what you're after, which most of these companies, that's kind of what most of these companies print as, you get ready, you get ready for some volatility. So
Fully agreed. And also there's the fact that not only are these super speculative stocks or companies, but also if you're playing in the exploration companies, the fact they have gold in the name doesn't mean they even have gold in the ground. So buyer beware. know that what you're buying is very
tell them
much
to use my
speculative.
rule, Fabi, tell them to use my 2 rules.
Yes,
Use Don's rules.
just use Don's rules. Just use Don's rules, and you'll be fine. Because I know Don. Like in the last bull run, it was 2011, and I was one of the newbies coming in and buying stuff that had gold and silver in the name,
Oh
right? And
yeah,
so I
you got
know
rug
that
pull. You
this
got rug pull.
I know all about it. I've lived it. So this is your fair warning for sure. All right. Thank you so much, Don. I hope to speak to you with more updates in the future. Maybe who knows? I mean, if this bull market goes to 2028, like you said, maybe we'll be talking about $10,000 gold. Who knows? But thank you so much and take care. I'll chat to you soon.
Yeah, thank you, Fabi. It was fun.